For most people, debt feels normal. Mortgages, credit cards, student loans, government deficits, all of it has become so embedded in daily life that it no longer feels unusual. Debt is no longer viewed as a temporary tool. It is viewed as a permanent feature of the system. But throughout history, debt has always followed a cycle. It grows slowly at first. Then it accelerates. Then it reaches a point where it can no longer be sustained. And when that point is reached, the consequences are never small. Every major financial crisis has been preceded by an extended period of excessive debt growth. Not because debt is inherently bad, but because debt changes behavior. It alters incentives. It reshapes decision-making. And eventually it distorts reality itself. What makes the current moment different is not that debt is rising. It is how long it has been rising without meaningful correction. For decades, global debt levels have increased faster than economic growth. Governments borrowed to stimulate economies. Corporations borrowed to buy back shares. Consumers borrowed to maintain lifestyles that wages could no longer support. Each cycle of borrowing created the illusion of stability. Each intervention delayed the consequences, and each delay made the eventual adjustment more severe. Historically, debt cycles operate in predictable phases. In the early stage, borrowing supports productive growth. Capital is invested. Infrastructure expands. Innovation flourishes. Debt fuels opportunity. In the middle stage, borrowing shifts from productive to speculative. Asset prices rise faster than incomes. Leverage increases. Risk is underestimated because recent history appears calm. In the late stage, debt no longer generates growth. It exists primarily to service existing debt. New borrowing is used to prevent collapse rather than to create value. This is the phase where systems become fragile. The defining feature of late-cycle debt environments is dependence. Markets become dependent on low interest rates. Governments become dependent on deficits. Asset prices become dependent on constant liquidity. Any attempt to normalize conditions threatens the entire structure. Interest rates cannot rise without triggering instability. Spending cannot be reduced without recession. Debt cannot be allowed to unwind without pain. So the system chooses delay. Central banks intervene. Liquidity is injected. Balance sheets expand. Short-term stability is preserved at the cost of long-term fragility. This pattern is not theoretical. It has repeated throughout history. In the 1920s, credit expansion fueled speculative excess. Margin debt surged. Asset prices detached from fundamentals. When tightening finally occurred, the adjustment was catastrophic. In the late 1990s, leverage moved into technology markets. Debt financed growth projections rather than earnings. When confidence broke, capital evaporated. Before 2008, debt migrated into housing. Financial engineering transformed risk into products that appeared safe. The system collapsed not because housing prices fell, but because leverage magnified small declines into systemic failure. In each case, debt was not the cause of prosperity. It was the amplifier of instability. What we see today combines elements of all three periods. Government debt levels exceed historical norms. Corporate leverage remains elevated. Household balance sheets appear stable on the surface, but rely heavily on asset prices that have been inflated by years of monetary accommodation. What makes this environment particularly dangerous is complacency. When debt remains high for long enough, it stops being perceived as risk. Investors begin to assume it will always be managed. Policymakers begin to believe interventions can always prevent collapse. History suggests otherwise. Debt cycles do not end because people decide to end them. They end because the system reaches a point where continuation becomes impossible. That point can be triggered by rising inflation, falling growth, political instability, or loss of confidence. The trigger varies. The outcome does not. When debt burdens exceed the capacity to service them, adjustments occur through one of three mechanisms: default, inflation, or restructuring. None of these are painless. Defaults destroy capital and confidence. Inflation erodes purchasing power. Restructuring redistributes losses in ways that are rarely orderly. In past cycles, societies often attempted to choose the least painful option. They rarely succeeded. The longer the delay, the fewer the choices remain. One of the most dangerous assumptions in modern markets is that debt can grow indefinitely as long as interest rates remain low. Low rates reduce immediate pressure, but they do not eliminate risk. They concentrate it. They encourage borrowing by suppressing the cost of leverage. They inflate asset values, increasing sensitivity to future shocks. They reduce the margin of safety throughout the system. When rates eventually rise, or when liquidity conditions tighten, the adjustment is rapid and unforgiving. What matters most is not the level of debt alone, but the system's reliance on its expansion. When growth depends on increasing leverage, stability becomes an illusion. At that point, the cycle has already progressed far beyond the early stages. The question is no longer whether adjustment will occur. The question is how it will unfold. And history suggests that once debt cycles enter their final phase, the resolution is rarely controlled. For much of modern financial history, central banks were viewed as referees. They adjusted interest rates, managed liquidity, and intervened occasionally when markets became unstable. Their role was limited, their tools were blunt, and their influence, while important, was not absolute. That changed after repeated crises. Each major downturn expanded the role of monetary authorities. Each intervention set a precedent. Each success encouraged greater reliance on policy support. Over time, markets stopped reacting primarily to economic fundamentals. They began reacting to central bank signals. This shift altered the entire structure of the debt cycle. When central banks lower interest rates, borrowing becomes easier. Asset prices rise. Risk-taking increases. Initially, this supports recovery, but when low rates persist for too long, they create distortions. Capital flows not to the most productive uses, but to the most leveraged ones. Companies prioritize financial engineering over innovation. Governments postpone fiscal discipline. Investors chase yield regardless of risk. The system becomes conditioned to cheap money. Eventually, the economy reaches a point where interest rates can no longer rise without causing damage. Debt servicing costs become too sensitive. Asset valuations become too fragile. Growth becomes dependent on continued accommodation. This is what economists refer to as a monetary trap. In such an environment, central banks lose flexibility. If they tighten policy to control inflation, they risk triggering recession or financial instability. If they ease policy to support growth, they risk fueling further inflation and asset bubbles. Either choice carries consequences. The idea of a soft landing assumes that policymakers can fine-tune outcomes with precision. History suggests this assumption is optimistic at best. Soft landings are rare because debt cycles do not unwind gradually. They unwind when confidence shifts. Markets tolerate imbalance as long as liquidity flows freely. When liquidity tightens, tolerance disappears. Central banks attempt to manage expectations through communication. Forward guidance becomes as important as policy itself. Words are chosen carefully. Signals are calibrated, but communication cannot eliminate structural constraints. When inflation rises, central banks are forced to respond. When growth slows, political pressure intensifies. When asset markets wobble, intervention becomes expected. This creates a cycle of dependency. Each intervention reduces the system's ability to function without support. Each rescue reinforces the belief that risk will be socialized. Over time, market discipline erodes. This dynamic is not accidental. It is the predictable result of prolonged intervention in late-stage debt cycles. Historically, central banks faced similar challenges. In the 1970s, prolonged accommodation contributed to persistent inflation. Attempts to stimulate growth through monetary expansion ultimately reduced purchasing power and required aggressive tightening. In Japan, decades of low rates stabilized the system, temporarily but entrenched stagnation. Debt levels rose while growth remained subdued. The adjustment was delayed, not avoided. In Europe, monetary union constrained fiscal flexibility. Debt accumulated unevenly across member states. Intervention prevented collapse, but structural imbalances persisted. In each case, policy responses bought time. They did not resolve underlying issues. What makes the current environment particularly complex is scale. Global debt levels are higher than ever. Financial markets are more interconnected. Policy responses are larger and faster. Central bank balance sheets have expanded dramatically. Liquidity injections that were once considered extraordinary are now routine. This expansion has consequences. Large-scale asset purchases distort price discovery. Bond yields no longer reflect risk accurately. Equity valuations become detached from earnings. Investors adapt by taking on more leverage. When safe returns disappear, risk becomes normalized. The boundary between monetary and fiscal policy blurs. Governments rely on central banks to finance deficits indirectly. Central banks rely on governments to maintain confidence in currency systems. This interdependence reduces independence. Once central banks become essential to fiscal sustainability, their ability to act independently diminishes. At that point, monetary policy becomes political. Inflation expectations become harder to anchor. Confidence becomes more fragile. Policy mistakes become more costly. One of the most dangerous assumptions in modern markets is that central banks can always step in if conditions deteriorate. This assumption ignores constraints. Central banks cannot control supply shocks. They cannot create productivity. They cannot eliminate demographic pressures. They can influence financial conditions, but they cannot override economic reality indefinitely. When debt levels are high, even small policy shifts can have outsized effects. A modest rise in rates increases servicing costs across the system. A reduction in liquidity tightens financial conditions rapidly. A change in expectations triggers repricing. Late-stage debt environments are highly nonlinear. This means outcomes are not proportional to actions. Small events can produce large consequences. Confidence, once lost, is difficult to restore. Central banks understand this risk. That is why policy decisions become increasingly cautious. That is why normalization is postponed repeatedly. But postponement has a cost. The longer imbalances persist, the fewer options remain. Eventually, central banks face a choice between preserving currency stability and preserving asset prices. History shows that this choice is unavoidable. When inflation pressures build, maintaining credibility requires action. When action threatens markets, hesitation increases. This tension defines the final phase of debt cycles. The belief that central banks can engineer a painless resolution is comforting. It is also inconsistent with historical experience. Debt cycles resolve through adjustment, not management. The role of policy is to influence timing and distribution, not to eliminate consequences. When systems become too reliant on intervention, resilience disappears. And when resilience disappears, shocks become systemic. Every late-stage market cycle shares one defining feature: confidence, not optimism, not greed, confidence. Confidence that risk is understood, confidence that volatility is manageable, confidence that institutions are in control. This confidence does not emerge suddenly. It builds slowly, reinforced by years of stability and intervention. Each correction that is quickly reversed strengthens belief. Each crisis that is contained reinforces trust. Each warning that fails to materialize is dismissed. Over time, investors stop asking whether markets are fragile. They begin assuming resilience is permanent. This psychological shift is subtle but powerful. Early in cycles, investors demand compensation for risk. They diversify, they hedge, they prepare for uncertainty. Late in cycles, preparation feels unnecessary. Volatility becomes an inconvenience rather than a signal. Drawdowns are viewed as opportunities rather than warnings. Leverage is rationalized as efficient. Risk is no longer feared. It is engineered. One of the most common phrases heard near market peaks is that conditions have fundamentally changed. Technology has improved efficiency. Policy tools are more advanced. Data is more transparent. Institutions are more sophisticated. These statements are not entirely false, but they overlook a constant. Human behavior does not change. Fear, greed, overconfidence, and denial remain consistent across generations. What changes is the context in which these emotions express themselves. In modern markets, complexity creates an illusion of control. Models are more detailed, instruments are more diverse, risk appears quantifiable, but complexity often obscures fragility rather than reducing it. When systems become too complex, participants rely on assumptions they do not fully understand. Interdependencies multiply. Feedback loops intensify. This makes markets efficient under normal conditions and unstable under stress. Late cycle psychology is characterized by narrative dominance. Stories replace analysis. Themes replace data. Consensus replaces skepticism. The most compelling narratives are those that explain away risk. High valuations are justified by low interest rates. High debt is justified by stable growth. High leverage is justified by liquidity. Each justification reinforces the next. Dissent becomes uncomfortable. Those who question sustainability are labeled pessimists. Those who reduce exposure are accused of missing out. Career incentives reinforce conformity. Fund managers who underperform by being cautious risk losing clients. Analysts who challenge consensus risk losing credibility. Institutions that resist trends risk irrelevance. As a result, skepticism becomes scarce, precisely when it is most needed. This is not a failure of intelligence. It is a feature of human systems. Social proof matters. When everyone around appears confident, doubt feels irrational. When prices rise consistently, caution feels unnecessary. Markets reward confidence until they punish it. Late cycle behavior also includes time compression. Long-term risks are discounted heavily. Short-term performance dominates decision-making. The future feels distant. Warnings about sustainability are acknowledged intellectually, but ignored practically. This is how bubbles form without universal euphoria. Contrary to popular belief, market peaks are rarely characterized by extreme excitement. They are often characterized by calm confidence. Volatility is low. Correlations are stable. Drawdowns are shallow. This calm creates vulnerability. When shocks occur, they are unexpected, not because they are unforeseeable, but because they are psychologically inconvenient. The initial reaction is disbelief. Markets hesitate. Participants expect intervention. Confidence delays adjustment. But once confidence breaks, adjustment accelerates. Late cycle psychology also affects policymakers. Officials become invested in stability narratives. Success is measured by avoided crises rather than resolved imbalances. Warnings are acknowledged privately but softened publicly. Communication becomes optimistic by necessity. This creates a gap between risk and perception. The public believes stability is durable. Markets assume support is guaranteed. Policymakers assume gradualism is possible. These assumptions reinforce one another until they fail simultaneously. One of the most dangerous dynamics at this stage is reflexivity. Prices influence behavior, and behavior influences prices. Rising asset values increase confidence, which increases risk-taking, which further increases prices. This feedback loop is self-reinforcing. It only reverses when something external disrupts it. Often that disruption appears minor in isolation: a policy shift, a liquidity event, a geopolitical shock, a credit incident. What matters is not the trigger itself, but the system's sensitivity to it. Late-stage systems are sensitive because they lack buffers. Leverage reduces margin for error. Correlation reduces diversification. Liquidity dependence reduces resilience. When confidence breaks, selling is no longer discretionary. It becomes forced. Margin calls occur. Risk models adjust. Volatility spikes. Participants who believed they could exit quickly discover that liquidity disappears precisely when it is needed most. This is why late cycle downturns feel sudden. They are not sudden. They are non-linear. Psychology shifts faster than fundamentals. Once confidence erodes, narratives reverse. What was previously justified becomes criticized. What was ignored becomes obvious. What was dismissed becomes urgent. Warnings that were ridiculed are rediscovered. Risks that were discounted are repriced. The same complexity that created confidence amplifies. Panic interconnections transmit stress rapidly. Markets that appeared diversified move together. Late cycle psychology also includes moral hazard. Participants assume losses will be absorbed by the system. Risk is externalized. Responsibility is diffused. This reduces incentives for caution. When consequences are delayed or socialized, behavior becomes more aggressive. Over time, this increases systemic risk. The paradox is that systems appear most stable just before instability emerges. Stability breeds complacency. Complacency breeds fragility. This pattern repeats across cycles. It is visible in credit markets before defaults rise, in equity markets before volatility spikes, in real estate markets before liquidity dries up. The specifics differ. The psychology remains constant. Late-stage environments also distort risk perception. Gradual deterioration is ignored. Sudden deterioration is exaggerated. Small improvements are celebrated. Structural weaknesses are minimized. This creates asymmetric reactions. Good news produces small gains. Bad news produces outsized losses. This asymmetry is a hallmark of late cycle markets. When positioning is crowded, exits become narrow. One of the most telling signs of late cycle psychology is language. Words like resilient, contained, and transitory become common. Uncertainty is reframed as opportunity. Volatility is reframed as noise. History is referenced selectively. Periods that support optimism are emphasized. Periods that contradict it are dismissed as irrelevant. This selective memory reinforces confidence. But history does not repeat selectively. It repeats structurally. The belief that this time is different is rarely stated explicitly. It is implied through behavior. When valuation discipline disappears, when leverage is normalized, when caution is penalized, the belief is already embedded. Late cycle psychology is not irrational. It is adaptive behavior in a system that rewards risk-taking until it doesn't. Understanding this dynamic is essential because it explains why warnings are ineffective. Information alone does not change behavior. Incentives do. As long as confidence persists, adjustment is delayed. And the longer adjustment is delayed, the sharper it becomes. When debt cycles reach their final phase, history does not provide dates. It provides patterns. This distinction matters. The desire to predict exact timing is strong, but it is rarely useful. Markets do not collapse on schedules. They collapse when pressure exceeds tolerance. What history reveals is not when adjustments occur, but how they unfold once they begin. Every major debt-driven downturn shares a similar resolution process. It starts quietly. The first signs are subtle. Liquidity tightens in specific corners of the market. Volatility increases modestly. Credit spreads widen, but only slightly. At this stage, confidence remains intact. Market participants interpret early stress as temporary. Policymakers reassure. Commentators emphasize resilience. This phase can last longer than expected. In 1929, warnings about leverage circulated for months before the crash. In 2000, valuations remained elevated, even as momentum weakened. In 2007, credit markets showed strain well before equities reacted. Early signals are rarely decisive. They are dismissed precisely because they lack drama. The next phase involves recognition. Stress becomes visible across multiple areas. Volatility rises more consistently. Liquidity becomes selective. Correlations increase. At this point, narratives begin to shift. What was once framed as strength is reframed as vulnerability. What was once dismissed becomes relevant. Still, optimism persists. Investors expect stabilization. Policymakers promise support. Markets attempt to recover. This phase is often marked by sharp rallies. These rallies reinforce belief that the worst has passed. They encourage risk-taking. They pull participants back into exposure. Historically, these rallies are some of the most convincing. They occur because liquidity injections, policy responses, or short covering temporarily relieve pressure. But relief does not equal resolution. The underlying imbalance remains. The final phase begins when confidence breaks. This break is rarely triggered by a single event. It occurs when multiple stresses converge. Liquidity dries up, leverage becomes unmanageable, forced selling accelerates. At this point, markets move faster than policy. Interventions that once stabilized conditions lose effectiveness. Trust erodes. Volatility becomes disorderly. In 1929, margin calls cascaded through the system. In 2000, capital dried up for speculative ventures. In 2008, interconnected leverage turned localized losses into systemic collapse. The mechanics differ. The sequence does not. Once confidence is lost, adjustment becomes unavoidable. Debt must be reduced. Losses must be recognized. Capital must be reallocated. This process is inherently disruptive. Attempts to prevent it often worsen it. When losses are delayed rather than addressed, they accumulate. When leverage is supported rather than unwound, fragility increases. History shows that resolution occurs through one or more of three channels. Default eliminates debt directly, but destroys capital. Inflation reduces debt burdens indirectly, but erodes purchasing power. Restructuring redistributes losses, but often involves political conflict. No option is painless. Societies typically choose the path of least immediate resistance. This choice shapes outcomes. In some periods, inflation is tolerated to avoid defaults. In others, defaults are allowed to restore discipline. In many cases, restructuring occurs gradually through regulation and policy. The common outcome is adjustment, not avoidance. What distinguishes successful resolutions from prolonged stagnation is acknowledgement. systems, recover faster when losses are recognized and reallocated. They stagnate when imbalances are preserved. Japan's experience illustrates this. Prolonged support delayed adjustment, resulting in decades of subdued growth. In contrast, periods that allowed painful but decisive adjustment often experienced stronger long-term recovery. The lesson is not that pain is desirable. It is that denial is costly. For modern markets, the implication is clear. High debt environments reduce flexibility. Late-stage cycles magnify sensitivity. Confidence becomes fragile. The absence of immediate crisis does not imply stability. Stability at this stage often reflects equilibrium under artificial conditions. When those conditions change, equilibrium shifts rapidly. This is why history emphasizes preparation over prediction. Understanding patterns allows participants to manage exposure, expectations, and behavior. It discourages reliance on perfect timing. It encourages resilience. Resilience does not mean pessimism. It means acknowledging uncertainty. It means recognizing limits. It means avoiding over-reliance on assumptions that depend on continued intervention. The most dangerous assumption in late cycle environments is that the future will resemble the recent past. Recent stability is often the product of accumulated intervention, not structural health. When intervention reaches diminishing returns, outcomes change. History suggests that late-stage debt cycles resolve not with clarity, but with surprise. Events that were theoretically possible become practically unavoidable. The transition from stability to instability is not linear. It is abrupt. This is why warnings often feel premature until they feel obvious. By the time consensus recognizes risk, adjustment is already underway. The goal of studying history is not to induce fear. It is to restore perspective. Debt cycles are not moral failures. They are systemic processes. They emerge from incentives, behavior, and policy choices. Understanding them does not guarantee avoidance. It allows for informed response. Markets will continue to function. Capital will continue to flow. Innovation will continue, but cycles will continue as well. The final phase of a debt cycle is not the end of an economy. It is the end of a structure. What follows depends on choices made during adjustment. Preparation does not eliminate uncertainty. It reduces vulnerability. History does not repeat perfectly. It repeats directionally. Recognizing the direction matters. The patterns are not hidden. They are uncomfortable. And discomfort is often the most reliable signal that a system is approaching its limits.